So, Commercial Bank of Ceylon posted a huge profit jump. Looks great on the surface, right? But what's really interesting is how they did it. Turns out it's all down to what I'm calling a triple engine strategy, and it tells you a lot about the quality of that profit. All right, just a quick heads up. This is purely fundamental analysis for educational purposes. It is not financial advice. Okay, let's get right to it. Here's the number everyone's talking about, a 52.4% jump in profit after tax. Wow. But whenever you see a number that big, you've got to ask yourself, how good are these earnings, really? What's the quality behind that number? So, yeah, how exactly did they engineer this? Was it just some one-off thing, a flash in the pan, or is there something more sustainable going on under the hood? Well, the answer is what I'm calling a triple engine strategy. We're talking about three different but connected things all firing at once. So let's break down that first engine. All right, engine number one. This is all about raw profitability, basically squeezing more profit out of their main job, which is lending money. And this is where it gets really interesting. Check this out. On their P&L, the bank's interest costs, they were totally flat, didn't budge. But then you look at the balance sheet, and you see deposits grew by a massive 283 billion rupees. Now, how is that even possible? I mean, more deposits should mean you're paying out way more in interest, right? Here's the solution to that puzzle. It wasn't about the amount of deposits, it was about the type of deposits. They changed the mix. They pulled in a lot more CASA, that's current and savings accounts. You can think of CASA as basically the cheapest money a bank can get its hands on. So by grabbing more of this super low-cost funding, they completely canceled out the cost of that huge growth in deposits. It's a really clever move. But it wasn't just about getting cheaper money. They also got way more efficient at running the bank itself. Their cost-to-income ratio dropped to below 28%. I mean, that's a huge improvement. So think about it. For every 100 rupees they brought in, they were spending less to keep the lights on. They were making more on their loans and spending less to do it. That's a powerful combination. Okay, so that's engine one. Let's move on to the second engine, because this is where the story gets another layer. Look, it's great to grow, but you've got to manage your risk, right? This engine is all about the quality of their assets. In other words, how good is their loan book? And on the surface, the picture looks fantastic. Their non-performing loan ratio, that's basically the percentage of their loans that have gone bad, it dropped a lot. And a lower NPL ratio is exactly what you want to see. It means they don't have to put as much money aside for potential losses, and that flows right down to the bottom line, boosting profit. But a ratio can hide things. And this is why you've always got to dig deeper than just the headline number. And here is that crucial detail. Yeah, the ratio looked better, but the actual amount of bad loans went up by over 8 billion rupees. So why did the ratio go down? Simple, because the total loan book grew even faster. So what does this tell us? It tells us that, yeah, asset quality is better relative to the size of the bank, but they are still adding new bad loans to the pile. That is a really, really important distinction to make. Okay. So that brings us to the third and final engine. And honestly, this might be the most important one of them all. This is the reality check. It answers the big question. Are these profits actually real, or are they just numbers on a spreadsheet? To find out, we have to look at the cash. The metric we use for this is the cash conversion ratio, or CCR. I like to think of it as the ultimate lie detector for a company's profit. It asks one simple, brutal question. For every single rupee of profit you claim you made, how much cold hard cash did you actually generate? And the answer for Commercial Bank? A super strong 1.64 times. Let that sink in. For every 1 rupee of profit they put on their income statement, they actually generated 1.64 rupees in real cash. This is, without a doubt, a huge validation of their earnings quality. This proves it's not just paper profits. This is the real deal. So let's pull all of this together. After digging through the numbers, what are the big takeaways? I think there are 3 core lessons here that apply to analyzing pretty much any company. First, a company's liability mix can be a secret profit engine. Seriously, how a business funds itself can be just as important as what it sells. Second, when it comes to bad loans or impairments, there's always nuance. Never ever trust just a ratio. You have to look at the absolute numbers. And third, and maybe you've heard this before, cash flow is king. Because at the end of the day, profit is an opinion, but cash is a fact. So, here's what it all boils down to. Profit, that's just a number. But the quality of that profit, that's a story. And it's a story that's written across all the financial statements.
The real question for you is, do you know how to read it?